All right, welcome back to the channel. We've got a Amazon earnings update. This video is going to be real short and quick, but Amazon reported earnings on Thursday and they had really good numbers. So we're going to take a look at the chart first as we're getting back up to that $200 resistance, and it's a nice move here. So Amazon was up 6% on Friday, so the day after their earnings, and they reported a beat on the earnings per share and the revenue, and they reported $159 billion in revenue in one quarter. $159 billion. Phenomenal. And an earnings per share of $1.43, which were both decent sized beats. And what I'm excited about is they guided for 186 billion for next quarter. So for the holiday season, they're expecting to see a nice quarter and $186 billion in one quarter. I've said this for a while. Amazon should be the first company to get 250 billion in a quarter and potentially $1 trillion in revenue for the whole year. So the way they're moving, they'll get there within the next 4 or 5 years. Let's go ahead and take a look at some of the snapshots when we're looking at Amazon. So their revenue growth year over year, 11%, driven by strong performance in Amazon Web Services. So their cloud division doing really well. AWS is up 19% year over year with $110 billion run rate annually. So really good, and triple digit growth in their AI services. So I've mentioned this before in previous Amazon videos. Amazon is a great way to play this AI trade that is out there. And on top of that, they have their shipping business, their online store that is helping fund some of this growth that they're having to do when it comes to AI. So really good stuff there for Amazon when it comes to the cloud. That's their big cash cow. That's their big growth driver. And then when we look at the Prime membership, record growth in Prime signups, benefits from recent events and new services. They have a fuel discount for certain fuel pumps where you can get 10% off a gallon if you're a Prime member. So things like that. And then you also have the Thursday Night Football. I think they had some MLB games, and they're going to have some basketball games. So, there's no reason to not have Prime if you're, at least for me, if you're in America. It's not that expensive. You can get a lot of stuff delivered to your house same day, next day, and you don't have to go to the store. So there's a lot of reasons why people should have Prime, and that's makes sense why there's record growth there. Operational efficiency. So they have been cutting costs. They've been cutting some middle managing positions, and then also they've been getting rid of some warehouse jobs. So when we're looking here at their efficiency, logistics optimizations, and then also robotics. So if you see some of their factories, it's just robots moving stuff around. When I first moved up to Sacramento, one of my first jobs was in a warehouse, and you would pull orders. You'd get a shopping cart, you'd see the list, and you'd go through the warehouse and pull the order and then bring it back, pack it up, put it in a box, send it off. Now, instead of me pushing a cart around, it's robots pulling things out on it's like full self-driving robots all over the place. They're going and saying, all right, we need to go to sector A and grab product B, and then grab, this product and then bring it back and put it in the box and send it to your house. So they're getting much better at that, and as AI continues to improve, that'll continue to pay off. So that's great to see that they're continuing to get more efficient, but at the same time, they're hiring a record amount of drivers. So they're kind of shifting the type of jobs that they're having, less people in the warehouse, less middle managers, but more people out on the road and things like that. So pretty interesting. So when you look at some of the negative points, they are going to continue to spend more. Now, I don't see this as a negative, but if you had to find negatives in the report, they're going to be spending more money on CapEx. So they're looking to spend $75 billion on CapEx in 2024 for infrastructure for AWS and generative AI. Shocker. Where have we heard that? From every other big tech company. They're going to spend more. Good revenue, keep spending. So they're getting the cash to come in. They can either buy back shares, give a dividend, or they can spend on GPUs to help grow their business down the road. So that's what these companies are doing to return value to shareholders, is they're saying this is the most efficient way for us to return value, is to build the infrastructure for the future. So it looks like the average selling price is slightly down. So you're seeing the consumer shift their purchasing to lower priced items. So maybe instead of buying Campbell's soup, you're buying the no-name brand or things like that. Instead of buying Hanes underwear, you're buying a no-name brand, something like that. So their price per unit is, revenue per unit is slightly down, but that's not the end of the world there. And then we are looking at a little bit of a sales decline. Third-party unit mix slightly decreased, impact by growth and lower margin everyday essentials. So, you know, they don't make money on selling deodorant to me and shipping it to my house. I've said that 1,000 times. So it looks like that is kind of eaten into them a little bit as well. And then we look at the graphic here for Q3. You can see our $159 billion in revenue. We've got a $15 billion in net profit. And then you can see where the money's coming in from. So you've got the online store, which is $60 billion. You've got Whole Foods and physical stores that are $5 billion. Third-party selling services is $40 billion. Advertising is $15 billion, and advertising is up 20% year over year. So that is the fastest growing segment of their business. Well, it's tied with Amazon Web Services. But after advertising, you've also got their subscription for Prime and Audible, which is $11 billion. And then you have Amazon Web Services, which is $27.5 billion, up 19% year over year. So their two most fast growing parts of their business is advertising and then Amazon Web Services. So again, people don't think of Amazon as an advertising play, but they are quickly increasing revenue quarter after quarter when it comes to their revenue. So I don't know too much about how Twitch is doing and how much revenue they bring in there, but I definitely know for their store, if I type in mouse and keyboard, someone is paying to put certain products up at the top of my feed, and Amazon gets a nice chunk of change on that, and that is all margin. It doesn't cost them any money for this $14.5 billion, maybe in some employee cost, but other than that, that's just pure profit, probably 90% profit there. So that's good to see. Although Twitch, they probably do have to pay for content. But that is really all I got. I don't have any other graphics that we haven't already looked at. Here's the revenue growth, again, accelerating for Amazon Web Services. This is from Q2, but we are growing at 19% as well. The cloud infrastructure, remember, Amazon is the big dog. Now, Google is growing pretty quick, but they're one of the smaller guys here. And then all these guys are still going to grow as well. This whole pie is growing, so all these companies should benefit. But Amazon is taking the biggest piece of the pie still. Revenue, again, this is just a phenomenal part of Amazon's business. And then when we look at advertising, you've got Amazon. It's still small compared to the big guys, but it's a side piece to their business, and it's adding to the balance sheet. One thing they didn't talk about was their Project Kuiper. They talked about that in the last earnings call, which is a competitor to Starlink. You know, Bezos has Blue Origin and other space ventures similar to Elon Musk. That is separate from Amazon, but this Project Kuiper for Amazon is something that they are using cash flow to help fund, and there could be a potential for a Starlink competitor, which is pretty interesting. Again, that could be just another potential sprinkle on top of this cake, and Amazon has a handful of other projects like that out there. They also are an investor in Anthropic, which is an OpenAI competitor. So there's a few other things baking in the oven that I'm sure we'll hear about further down the road. And if Amazon keeps having great quarters like this, it should be no problem for them to keep throwing cash into those investments, because they've got hundreds of billions of dollars coming in each quarter. So they can take some of that money and take some investment risk on some of these smaller projects that may turn out to be something like an Amazon Web Service, like a Whole Foods, like a Twitch that could eventually add to their balance sheet down the road. So really excited about this company. This is the second largest position across my portfolios, and just feel really good about this this company. When we look at the chart, we'll finish here. Again, we're hitting our head up against this $200 resistance. We've been here before. Wouldn't surprise me if we get a little bit of a cool off. I would like to buy some more at 180, but I'm being very patient. I bought some on this nice earnings dip that we had back here in the 150s. That was a nice opportunity to reload a little bit more. But this stock has not really gone anywhere since 2020. So I do think we are on the verge of a breakout, whether it happens now, whether it happens in this back half of 25. I do see us getting up into the 240s, 250s, 300s within the next couple of years, because the fundamentals here for the business has increased quite a bit. So back in 2020, revenue was $80 billion. Now we are at $180 billion guided. So that's $100 billion added to the revenue, and the stock price hasn't moved a whole lot. So I do think there is plenty of catch up to happen here in this stock within the next couple of years, and that is why it is one of my larger positions. And we'll just have to wait and see. But being patient here, I do have some covered calls at $200, which we're getting close and testing that. I will probably have to roll those out or just close them, which is fine. I was hedging myself going into earnings, not a problem. I did that with Tesla as well. And if you have to roll those out and you don't get the full upside of the move, that's a good problem to have, because it easily could have gone this way, as we saw last earnings where it was down 20% after the earnings call. So that's why you have a small hedge and you accept the risk that if the stock goes up 10%, maybe you only get 8% of that upside because you're hedged, but if the stock goes down, you get to reduce some of the downside as well. So anyways, that is the update on Amazon. Great quarter. I'd give it a B+. I mean, their guide is going to be interesting, so I'm really curious for Q4. They have mentioned some softness with the consumer. We're seeing that in other places as well. So holiday season will be interesting to see if they can meet that expectations, because $180 billion seems to be, to me, to be a high bar to set. But they've got a lot of ways to pull in money. So we'll have to wait and see. So that is all I got for Amazon. Hope everyone has a great rest of your weekend, and world champs, baby. Go Dodgers. All right. Peace out.